All right, let's be honest here. Do banks really buy whole life insurance? You know, it's weird because some people trust banks with their money more than they trust their own mother. By the way, hi mom. So I'm just saying this because the crazy thing is, where do banks put their money? Where do they want to keep their money and where do they trust it to be safe? Believe it or not, it actually is life insurance companies. But why would they be so crazy to do that? Well, let's dive in to find out why and how you could actually use it too. All right, so let's just jump into why do banks really want to use whole life insurance? Why do they put their money there? Now, I actually thought this was a bunch of crap, to be honest, right? When I was a financial advisor, I used to teach people all the time, whole life insurance is a big waste of money, don't do it. Buy term, invest a difference, or buy something that's more stock market related, right? But when I started to really study this, and there's a great book out there called Pirates of Manhattan, you actually study it, you realize that banks put a significant amount of cash in life insurance. And in fact, it was interesting because I was just having a conversation the other day with another real estate investor, and he said, Chris, you know what got me to do this whole life insurance, this infinite banking thing? He's like, the thing that got me was I had a friend who came from a family that owned banks, like literally owned banks. And their family would not store their money in their own bank. They would actually store their money in the life insurance that the bank would then own. They call it bank-owned life insurance, or BOLI. And he said, yeah, they actually trust putting money in whole life more than their own bank. And I said, that seems ridiculous. That seems crazy. Why? Here's why, guys. Banks have different, what we call tiers of capital, right? They have 4 different levels of capital, of risk levels, right? So like tier 1 capital means they just hold cash. Now, if they have cash, the law allows them to loan out $10 for every dollar they have in cash. This is why banks actually have more debt than they have in assets. This is a shocker. I know for all you Dave Ramsey fans, and even Dave Ramsey, he says that people are dumb if they have debt. Well, guess what? Banks have more debt than everybody, but they also have more money too. And what do they use? They use this money. So they have cash sitting on the side. Now, if they have cash sitting on the side, they don't earn any money on it. Yes, they can leverage and loan out $10 for every dollar you give them. So if you put $10,000 in a savings account, they have the ability to loan out $100,000. But in tier 2, guess what shows up in that one? It's also very safe assets like life insurance. And life insurance pays much better than 0%. You know, in many cases, they pay at least 5 or 6% a year, and it's tax-free. They have tax-free savings and guaranteed returns coming in. So they're earning money on that, and they can still usually loan out at least 7 to 8 times the amount of money that's there. And so they look at that money as money they can still leverage and use and make more with it. And of course, if you use life insurance companies, here's the thing. Did you know life insurance companies are actually safer than banks? Now, you've probably heard of like FDIC, right? You've heard of FDIC, that's what protects your money in case the banks fail. That started happening after the Great Depression because what happened then? Out of over 35,000 banks, only 13,000 survived the Great Depression in the 1930s. We went from 35,000 down to 13,000. That's almost 2/3 of banks failing just in those few years. Life insurance companies, 4 failed. That was it. It was just a few failures and that was all. Well, since that time, they got FDIC to help protect your money. It only protects up to $250,000 and they say they protect it, but here's the reality. FDIC only has about 1.5% of savings in there. That means if we ever have another bank failure, kind of like what we had in the last recession, but maybe it's worse this time around. What if 10% of banks fail? Well, if they only have 1.5% of reserves in place for the 100% or even the 10%, I can guarantee it might take some time for you to get your money back. You might be waiting for that money, wondering when it's going to actually come, waiting for some government bailout or something to happen where that money will come back. That's the risk. This is why my friend was talking to his banker, you know, the person that owns a bank, saying, yeah, we don't want to keep all our money here because even we know we're not safe. But in life insurance companies, they have what's called reinsurance backing them up. Reinsurance are insurance companies that insure insurance companies in case they ever go under. Now remember, banks take higher risks. Banks, they can loan 10 times the amount of money that they have in their cash, right? Well, what if people stop paying them? What if we have another recession, people stop paying them back? That's why banks can still fail. But life insurance companies don't do that. They don't have the ability to loan out more money than they have. They can only use the money that they have. They're not allowed to use debt like that. So as a result, insurance companies don't fail anyways. Well, even if they did, and other insurance companies back them up, they're all required to have what's called reinsurance, and reinsurance protects them from failure, or really protects you from any kind of insurance company failure. That protects your cash that's in there, the cash savings account, that cash value is protected, and your death benefit. So in reality, the truth is, an insurance company, and even the money that you have in there, is better protected than the bank. It's also not subject to all the market swings and things like that. The stock markets don't affect it. Interest rates don't affect it. In fact, if interest rates go up, usually over time, it means that your payments also go up too because you make more interest when interest rates go up. So you have this guaranteed return, it's safer than the bank, and it's also tax-free. This is why banks love to use insurance companies. They use them as their banks, if that makes sense. That's where they go to put their money. Now, they don't put 100% of their money there, of course, we know this, but it's not uncommon to see banks have anywhere from 10 to 20, sometimes 25% of their cash in insurance companies. So what does that mean for you? Here's the good news for you. You can actually use this more effectively than even the banks use. Because when the banks use it, a lot of times they're trying to get on executives or their other key employees. They're trying to get on the people that way. Well, they get some benefits, but they don't get all the tax benefits they might get otherwise. So they lose some of that. They also may not necessarily have somebody who has great health, that they're trying to put the policy on, right? Because again, they have to have some insurance on some people that usually work internally within the company, and then they use that as a way to store cash. Well, you can do it with yourself, especially if you're in great health. If you're younger, the younger you are, the better. Now, by the way, just so you know, if you're under the age of 70, this can still work as a great strategy for you. Over the age of 70, it could work, assuming you have good health still. But it's a little bit harder, it's gonna be more expensive. But the younger you are, the better the return you get. And it can be more flexible, and you get full tax advantages because that money grows tax-free and it comes out tax-free. That's the beauty of this, right? Is that it's like a Roth IRA, but you don't have all the limitations you get with a Roth IRA. Because for example, Roths might say you can only put in $6,000 or $7,000 a year, and those rules change slowly over time. On top of that, if you make too much money, they'll say you're not qualified to be able to put money in a Roth IRA. Well, with this, you can make as much money as you want and still be able to contribute. And the cool thing is this, you can contribute up to 25% of your gross annual income. So if you make $100,000 a year, you can contribute $25,000 a year. You make $500,000 a year, you can contribute $100,000 a year. And by the way, that's not based on tax returns necessarily. That can be based just on what you know your gross pay actually is. You could put away a lot more money, grow it tax-free, and here's the cool thing. You can also use it like the bank does. Remember, the banks don't just let their money sit on a shelf and collect dust. They're always putting their money in motion. They're always using their money. Yes, they'll keep some money in reserves for safety, as you should too, right? But they're also moving money. They're investing it. They're investing it in other people by giving out loans and things of that nature. You can do the same thing. You can do actually, like if say somebody says, I can pay you 10% a year on a real estate loan, you're like, well, that's cool. I like that. Yes, you'll borrow money from the insurance company, just like they are the bank. You'll borrow money from them. You will pay them interest when you do that. But here's the good news. They're also paying you interest on the money that you didn't pull out. So say, for example, you had $100,000 sitting in there. You want to use $50,000 to then lend to a real estate investor to earn 10% a year on. Well, that $100,000 is still in there. It's not like you pull out $50,000 and now you've only earned interest on $50,000. You still earn interest on the full $100,000 because you're borrowing the money from the insurance company instead. You're using their money to invest, right? Just like the banks do when they use your money in the savings account to invest by loaning out that money to other people. So now you're doing the same thing in reverse. Now you're the bank. You borrow the money from the insurance company. Yes, you're being charged interest, but you're being paid interest on that full amount. They didn't pull it out. And then you use that money to go make money off of it. That 10% comes back and you use that to pay down the loan. And so the cool thing that starts happening is over time, you start earning more interest here than you pay them in interest. So you earn a net positive interest rate here within the insurance company, and you're still earning the 10% return off the money you've invested. That's making money in two places at the same time. That's leverage. That's arbitrage. That's the way that banks make money, but you can even do it at a better level. Yes, much smaller level, right? Because you're not doing this with millions or billions of dollars, but you might be doing this with thousands of dollars, maybe millions. But at least thousands of dollars, you could be doing this very same thing. I actually did the same thing recently with a $50,000 loan that I did for one of my friends that was a real estate investor. He offered to pay me 15% a year. Can you imagine how much more money I was making off of that, right? Especially as I'm paying down that loan faster. I've done it with real estate rentals, where you can actually use the cash flow from the rentals to pay the loan down. And as you pay the loan balance down, it also increases the amount you can then turn around and reinvest again. So I can actually reinvest my money faster than if I just use a simple bank savings account to slowly build that little cash flow of a few $100 a month in there. That's the cool thing. That's the beauty of this, is that you can actually get your money to work not just faster, but in two places at the same time, earning more interest. I've even used an example, if you guys have ever gone to my Money Ripples podcast channel, I use an example where someone bought a $1 million apartment building with $250,000 down payment using their policy as compared to using money from the bank. Because remember, when you withdraw money from the bank, you're no longer earning interest there, are you? You have to slowly build that cash flow up. So as that $2,500 a month was coming from that apartment building, you're putting that in the bank, yeah, it slowly builds up, but over 9 years, after you pay taxes, you make like $1,000, $2,000 of interest. Where with the life insurance policy, I can make $120,000 of interest just using my own example, my own policy myself, able to make that much over a 9-year period of time. Guys, what would you rather have? $1,000 or $2,000 or $120,000 of interest, right? And by the way, that's net after I've paid interest to the insurance company. That's net gains that I've earned. That's the wonderful thing, the beauty that you can use when you start to use your money like the bank. When you start to think like the bank and then use your money like the bank does, because banks do invest. They do save their money into life insurance policies to store it, earn more money, and then use it and leverage it to make more off of that. You can do the same thing as well. If you want to know how you can actually do that, you can actually go to moneyripples.com, click on the Infinite Banking tab there. You can actually schedule a meeting with somebody to actually see the numbers and how it would actually look in your specific situation. I would just say this. If you can save at least $5,000 or $10,000 a year, you can probably qualify to be able to do something like this. If not, still you can talk to us. I mean, there's another strategy you can use, like using a convertible term policy to eventually get to that point where you start to create your own infinite bank, just like the banks do for themselves. So go to moneyripples.com, click on Infinite Banking today to find out how you can do it for yourself.